I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, March 28. Let's look at the litany of risks facing investors: rising inflation, a tightening Federal Reserve, elevated energy prices, supply chain imbalances, and the Russia-Ukraine war. But the bulls refuse to cede control. Corporate profit growth remains on track, albeit at a slower pace, and the global economy continues to expand. The pandemic is flaring up in certain regional pockets, but overall, it appears to be waning. Unemployment is falling and retail spending is holding firm. Another positive development is the remarkable unity lately of Western democracies. In only a few weeks, Russia's invasion of Ukraine has brought considerable cohesion to NATO and the transatlantic alliance. This sense of common purpose had eluded the free world for several years. Russian President Vladimir Putin has inadvertently brought America and Europe much closer together. That's a good thing for global finance because it shores up the rules-based international order that has generated global prosperity since the end of World War II. Accordingly, stocks posted a credible performance last week, considering the headwinds at play. Take a look at the following table. Technology stocks remain under pressure due to rising interest rates. Rising rates hurt growth equities because they erode the value of future earnings. According to research firm FactSet, for the first quarter of 2022, the projected earnings per share EPS growth rate for the S&P 500 is 4.8% as of March 25. If 4.8% turns out to be the actual growth rate for Q1, it would represent the lowest earnings growth rate reported by the index since Q4 2020, when it came in at 3.8%. Conversely, analysts are more optimistic than normal in their revenue estimate revisions. As of March 25, the S&P 500 is expected to report year-over-year revenue growth of 10.7%. 10 of the 11 S&P 500 sectors are projected to report year-over-year growth in revenues, led by the energy and materials sectors. Valuations remain comparatively high. The forward 12-month price-to-earnings PE ratio for the S&P 500 is 19.5. This PE ratio is above the 5-year average, 18.6, and above the 10-year average, 16.8. The value of the S&P 500 has fallen by 4.7% since December 31. However, the consensus of industry analysts is that the S&P 500 will rack up a price increase of 16.8% over the next 12 months. See the following chart for a sector breakdown. This chart shows how sectors will stack up over the next 12 months. Communication services will lead the way. Tailwinds are mounting again for higher crude oil prices. The combination of terrorist attacks on Saudi oil infrastructure and a likely ban of Russian oil exports to Europe has pushed up the price of West Texas Intermediate, WTI, the U.S. benchmark. The following chart shows the per-barrel price of WTI over the past 12 months. Higher crude, of course, feeds inflation, serves as a tax on consumers, and pressures corporate profit margins. Amid these uncertain conditions, where can you find new opportunities without undue risk? Turn to my colleague Nathan Slaughter, Chief Investment Strategist of Takeover Trader. Corporations are flush with cash, and they're about to unleash a feeding frenzy of merger and acquisition activity. You can profit from the coming chaos on Wall Street by following Nathan's advice. He has a knack for pinpointing big corporate deals before they happen. To gain instant access to Nathan's latest insights, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for today. Thanks for watching. Stay invested and please stay safe.